You're listening to The Weekly Edge, your straight-talking guide from industry experts on what's really moving the fixed income markets, here in Australia and around the globe. Brought to you by Gilt Investments. The Weekly Edge is your go-to podcast for sharp, actionable insights into the forces driving bond markets. Each week, your hosts Alistair Healy and Richard Brennan take you on a fun and insightful romp through the financial markets. With their no-nonsense style and deep experience, they help you cut through the noise. Alistair's deep market smarts and Rich's trend-driven mindset make for the kind of conversation that keeps investors sharp, and always one step ahead. Quick hits, smart takes, real perspective. Let's dive in.
G'day and welcome to the Weekly Edge. It's Thursday, the 10th of April, and if you've been wondering why markets feel a bit jumpy lately, you're not imagining it. There's been a lot going on this week. Big headlines, global drama, and some worrying signs for households here at home. With me, as always, is my good mate, Alistair Healy. He's our fixed income expert at Gilt Investments, basically the guy who knows what's going on in the world of interest rates, bonds, and all things money. So, Al, how's your week been? Still got your eyebrows after reading the latest from Jerome Powell?
Mate, good morning, Rich. Barely, I think, mate. Between the central banks, the tariffs, the market swings, which have been quite wild this week, there's a lot to digest at the moment.
So, well, let's get into it. Whether you're a full-time investor or just someone trying to make sense of where the world's heading, we'll break it down for you. No jargon, no waffle. So let's get into it. So, Al, let's talk about what's got everyone so rattled this week. President Trump's gone and slapped big new taxes called tariffs on goods coming into the US from China and Europe. We're talking 34%, even 50% in some cases. Markets didn't exactly take that well. So what's going on here?
Yeah, I guess as you just said, Richo, the tariffs are a big issue, and tariffs are going to basically turn the world upside down. It's really an environment. It's a totally different environment that we've been used to up until for the last 15 years. So it's going to make imports, particularly in America, incredibly expensive. Or it's going to push the price up, which is really what the government's aiming for, so that they stop buying imports and start fixing up their own economy. But the flip side to that is that in the process of going from an old system to a new system, it's going to slow the economy down. It'll push prices up definitely. It'll force businesses to reassess their spending and their hiring, which is going to turn the economy upside down. You can't just go from one area to the other area without some sort of a assessment and changing your whole business model, if you like. And when businesses, have to go through that process, it is, genuinely going to slow the market down. Markets will react to that. As we've seen, the stock market's fallen down. Investors get a bit jumpy, and we saw a lot of money, suddenly shifting around because it's like on a boat. The deck chairs start shifting. Everyone has to reassess because in totally different environment, different structure in the market. So money is going to flow around, and that's what we're seeing this week.
And China, they're not going to take it lying down, are they? They've said they'll fight back, and there's even talk they might weaken the currency to make their exports cheaper.
Yeah, definitely. Everyone's going to react because at the end of the day, America is the biggest consuming economy in the world, and everyone wants to tap into it. So now the Americans are going to put tariffs on everybody, and China exports something like 200, 300 billion, whatever the figure is, into America. So it's a big thing for them. So they're going to have to react. So it just depends. They've also got to contend with Trump. So they don't really know what to do. But their reaction up until now is to put tariffs on imports, American imports as well. So they're gonna try and basically do what Trump's doing. But it'll come down to who needs who the most. And I think China will probably need America more than America needs China. So it'll work better for them.
So for everyday people, for people with superannuation funds, for example, what does all this mean?
It means a bumpier ride. Now that we have countries who have started to play hardball on trade, it affects everything from retirement funds to interest rates on loans. which will make people far more cautious right now, trying to avoid making mistakes and taking risks. It's hard to know where the risks will be when you're changing the system so much. If you're pushing prices on things, you don't know what effect that's going to have on certain companies. So if you're buying shares, not that I'm a stockbroker, but that risk and that change in the market will manifest somewhere. So you've got to be a little bit cautious, I think, in this environment and try and keep an eye on things to try and work out where that risk is before you dive in. If you haven't dived in already, you're already in there, then you've got to adjust and try and avoid the risks. If you might be in an investment or in a position that might get slammed by these tariffs, so you have to adjust and get out.
Right. So the smart play is to stay alert, not make sudden moves, and keep an eye on what's happening globally, even if you're investing locally.
Absolutely. Whether we like it or not, we will be affected. We're part of the global market. Period. Where the fact that the Aussie dollar is a floating currency means that we're well and truly entrenched with the global markets. We're not a protected species, if you like. Our currency is not hedged by the Reserve Bank. It's floating and open. So whatever happens overseas will happen to us eventually. Might not be overnight, but it'll come to us eventually.
So let's bring it back home for a minute here to Australia. So we've seen a pretty sharp drop in consumer confidence. Basically, people are feeling a lot less positive about the economy and their own finances. And the survey showed a 6% drop overall and a 10% drop if you're asked after the news of Trump's tariffs broke. Al, that's a pretty decent slump, isn't it?
Yes, it is. Confidence is pretty much, most 100% of everything, really. If the economy is confident, consumers are confident, then it's reflected in the figures in the economy, and the economy then becomes more buoyant. And everyone who is part of the system, has, I guess the ulterior motive always is to keep that confidence going and get the right balance between, between not over pushing the economy so it's you've got a problem with inflation, but at the same time not slowing it down so badly that you've got de-inflation or we're grinding towards a recession. So confidence is a big thing that the authorities and people like that look at and keep an eye on, because you need to get that balance. Not too overconfident, not too underconfident, but so get that balance so it keeps chugging along how they want it to chug along.
And that means what exactly? Cheaper loans?
It Interest rates are the price for money. So depending on where the confidence is, depending on how strong the country is, will dictate where the price for money will be. And the price for money is both on our side, being fixed income brokers. We tend to be on the investment side and the liability side of the balance sheet. But yes, it definitely affects the lending side. And again, that depends on the circumstances in the market. If you've got a huge, robust, competitive market, then the loans are affected immediately because everyone's trying to keep their balance sheet going, and they're all continuing to make sure they're lending and their balance sheets are growing. If you've got, I guess, like Australia has in some respects, a monopoly type situation, the loans might not come down. We've seen in the past in Australia, deposits have definitely gone down, but loans have stayed where they are. It really comes back to the full monopoly, four banks that control the market. But logically, they should come down. So loans should be cheaper.
Okay, so now let's pivot slightly on the banking side of things. ANZ's been in a bit of hot water. APRA, the banking regulator, has basically said, hey, we don't like how you're managing risk. And they've forced them to set aside an extra 250 million just in case things go pear-shaped. That's not nothing.
That's right. Yeah, it is a reasonably big deal. The extra money, can't be used. Well, the extra money with the ANZ will stop the ANZ because it's got to allocate that 250 million onto its balance sheet. They probably have that in their retained earnings or something that they would put there, but they can't lend it out. But it's got to sit somewhere, so they'd probably lend it to someone else or buy other bank bills. So indirectly, it goes back into the market a little bit. But it will constrain the ANZ because banks are a margin game based on ratios and things. So they borrow at one level and they lend at the other level, and they've got to continue to lend. So they can't sit still. If they sit still, assets which are their loans, get paid off, every day. So it is a big issue, but to me, probably long overdue. And the authorities should be probably a little bit stronger than they have been so far.
So it's not just about the ANZ. This is probably going to fall across the entire banking sector.
Absolutely. The four pillars they're a privileged species. So the community backs them and helps them and supports them. So we should be getting the same corresponding, benefit coming back. But, unfortunately, they then, the client gets a bit lost in all this and they sort of focus on being the big guys and do whatever they like. So they have to be reined in a little bit by the authorities every so often. So yes, if the CBA or Westpac or the NAB or any big institution takes their eye off the ball and don't pay attention to what happened to ANZ, then it's going to be it will be their own fault sort of thing if they get dragged in.
It's kind of ironic, isn't it? So the competition watchdog tried to block ANZ's big merger with Suncorp, if we remember, saying it would hurt competition, but they got overruled. Now, not even a year later, the banking regulator's stepping in saying, actually, we're worried about how you're running things.
Yeah, absolutely. It's for me, the problem here is not so much the authorities appearing to be, whiplashing around. I think the real issue here is we've probably got too many authorities. So, we've got ASIC, APRA, RBA, AFMA, we've got the Australian Competition Tribunal that I didn't even know existed until the ANZ was allowed to take Suncorp. I mean, it makes ACCC farcical. So that to me, when you've got too many authorities, it's like anything. The banks know that they can almost get away with anything because you've got 4 or 5 people who are going to have different perspectives on life, and you're going to have all these reasonably well paid public servants or public authorities. They're all in their own little fiefdoms, and they all want to make an issue, and they all want to justify their existence. So they pay no attention to anyone else. They're just going to push their own barrow. So that just makes it easy for bigger institutions to probably get away with far more than they should. So
what should the average person take from all this?
For me, there is certainly a lot going on. There's not much you can do about the authorities and the running of the banking industry apart from voting with your feet. Basically the market, if you're investing or saving, it's a good time to be thoughtful. For me, don't chase it. You shouldn't ever really chase it anyway. You stay within your policy, you stay within, your risk appetite, you stay within what you're trying to achieve, stick to your gut feelings, things like that. If you're prepared to take a risk, then I try and put some parameters on that. The old days, they used to say, only punt once you can afford to lose. So work out what you're happy to lose and stick to it. If you're a conservative person and you don't want to lose anything, then really at the end of the day, you've got to go back to your gut feeling and stay with your what you're comfortable with your policy. So
yeah, couldn't have said it better. Keep it simple, stay steady, and don't fall for the headlines.
Absolutely. I'd almost say ignore the headlines. Stick to your gut feeling. Stick to your conservative. If you're a conservative person, then stay conservative. Yeah. Don't start buying ETFs. Buy government bonds if you're a conservative person.
So let's pivot. We've talked about tariffs and tension, but let's talk big picture now. How's the world economy holding up? Jerome Powell, the head of the US Central Bank, made headlines again this week. He's warning that things could get more expensive and grow more slowly at the same time. Not exactly a dream combination.
No, it's not. Not ideal at all. I really think the global markets right now are in a real state of flux. Definitely that is stagflation right there, where you'll have no growth but inflation. And that's one of the big no-nos. No authority really wants that, because that'll just basically gut people's standard of living. If the prices go up and no one's getting a pay rise, or you lose your job, it's not a good environment. I think right now the world is if you look around the world, there's just way too much debt, which the governments don't have enough capability or capacity to support anyone. We blew a lot of capacity back in 2008 to get the market back. That's now putting the world in a fairly tight situation where there's way too much debt at every level, from federal to state to local to household. So that basically puts people like Jerome Powell into a fairly
Rock in a hard place.
rock and a hard place big time. It's just so hard. I don't envy him at all, because then he's now got a president who's going to give him grief if he doesn't make the right decision. So I would hate to have his job right now.
So for everyday Aussies, what's the key takeaway? Higher prices, slower growth overseas. Does that reach us?
Yeah, look, Australia is connected to the rest of the world, especially when it comes to trade and investment. If the big economies slow down and get nervous, we'll feel it for sure. Our dollar, it's going to be reflected in the dollar. The dollar for me is really like the share price to Australia. So if Australia will get affected, we're part of, as we said earlier on, we're part of the global market. So whatever happens in the offshore markets is going to happen to us. Unfortunately, though, for me, we've put ourselves in a pretty vulnerable position because our debt level, we've now got close to $1 trillion at federal level. We've got another 700 or 800 billion at state level, and household debt's huge. So, we're in business terms, we're like a highly geared business now, where our revenue base has been affected a fair bit of late, and it's continuing to get affected. And now we've got, our suppliers, if you like, going to put tariffs on all their products. So in that environment where our revenues dropped and our debt levels is way too high, it's going to make us very vulnerable, and that'll be reflected in the currency.
And looking at things like oil and gold, we've seen oil prices drop, gold pushing back towards $3,000. What does that tell us?
Well, oil for me is, like a lot of these markets, they're heavily controlled by the people involved. So OPEC and those sort of places do control things a fair bit. If the economy is grinding to a halt, then oil prices should drop. So if you see oil prices going down, it indirectly could be a reflection on where the economies are. Gold, when it was the gold standard, it was a good reflection on currencies and things like that. When they released gold as the gold standard, then it's more like an insurance policy. It's an old commodity that still makes a little bit of sense. If you've got those who think Bitcoin's the way to go, and you've got others like me who say gold's the way to go because it's tried and proven, and it's been part of the community or part of the investment.
And our wives, of course,
Yes.
they believe that gold is the way to go.
Shh, don't mention the wives. So for me, gold has still got 3 or 4 characteristics that people like. It still can be used as a means of exchange. It can still be used in commercial, industrial, rings and jewelry and stuff like that. And it still is used by the reserve banks around the world. They have gold on their balance sheets to protect their currencies and things like that. It's not the gold standard as it used to be, but they still hold gold. So for those reasons, that's why, I'm not a commodity person, but gold's always worth looking at, I think.
So same old message, the world's wobbly and investors are looking for solid ground.
Yeah. Right now, for the next 12 months, I think you've got to be conservative because there's so much going on. There is not a person on this planet that knows which way any of these markets are going to go. So, based on that, you've just got to, you don't have to read too much either. You got to do your own homework. You got to have a really good glimpse of the world and the lay of the land, within your own parameters of risk and stuff like that. And then I think if you do some reading around, you'll see that the world is pretty much in a state of flux. There is so many issues that could fester that will turn markets upside down. Even looking at the stock market yesterday to today, it's a 2,000 point swing sort of thing for just a comment made by Trump. Yeah. So that right there gives you a pretty good idea of how volatile it is at the moment.
Okay, so let's pull it all together. We've got Trump throwing around tariffs like it's a sport, markets reacting like nervous teenagers, and a real sense that things could get bumpier before they get better.
Yes, definitely, because there's always a bit of a lag because the whole it comes down to confidence and consumption and things like that. So you've got a lot of people that don't, there's people that don't even look at the news. They don't even listen to anything. They'll just keep enjoying life. So it doesn't take much to go out and see where all the restaurants are, or even go to the airport, or you look at the cricket and you look at the concerts and the tennis. People are out there spending a lot of money. So there are certainly some people that are pulling their belts in. That will indicate that we're starting to do it tough. But you can look at other parts of the market, and they're out there enjoying life, and you wouldn't see it. So for me, that lag is there. Definitely, we've got the tsunami, I think, coming at us, but it's hard to read it because a lot of people on the street are still sort of behaving normally, and don't think it's going to happen. So, but I think it's going to be interesting in the next 12 months for sure.
So for people listening, what's the smart move right now?
But hand on my heart, you really have to be conservative. Just be careful of structured deals and stuff. Definitely things like government bonds or guaranteed term deposits. They're not sexy. They're probably not. You could go out there and buy an unrated junk bond and get 9%, but really, is it the right time to do it? I don't think so. I think just even for no other reason, for the next 12 months, just stay really, really conservative. Term deposits, government guarantees, government bonds, things like that. Things that you're comfortable with. Say corporate bonds. Simple, clear-headed, liquid, and well-rated. Definitely.
And for anyone wondering what it means for their super, their savings, or even their mortgage, it's a good time to ask questions and make sure your setup still makes sense for the world we're in.
Absolutely. Never bury your head in the sand ever. The temptation's there all the time. No one wants to know the bad stuff, but you've got to, for two reasons. One, you protect your existing position, but secondly, you might be able to take advantage of it. So you've got to keep your eye on it. It's not hard these days. There's a hell of a lot of information out there just to run your eye over and just get a bit of a feel. Don't feel shy on asking questions. Definitely superannuation. Knock on the door and ask them. Find out what's going on. Have a look at your portfolio all the time and your superannuation, and ask people in the market. Ring us anytime you like. We'll give you an opinion, right or wrong. We'll certainly give you a rundown of what we think.
Well, that's a wrap for this week's edition of the Weekly Edge. Thanks for tuning in. Whether you're a market nerd like us or just trying to keep your head above water in this crazy economic world, we hope we've made things a little clearer.
As I said earlier on, if you want insights like this, we put we put a newsletter out every day. We send, which is the Edge. Our website, if you want to receive the Edge, then just go to our website and hit the contact us, and then we'll put you in subscribe, and we'll put you on the list and send it out. We're absolutely open and free to take any calls. If you want to give us a call, we'll chat about the market, no problems. We're pretty much just fixed income, but the beauty of fixed income is that it does have a pretty big influence on the other two asset classes. If interest rates go up, it will affect property and it will affect the share market. Whilst we're not stockbrokers and we're not property people, we're fixed income people. But it's not a bad asset class to start with.
Thanks, Al. So until next time, everyone, stay safe, stay sharp, and we'll catch you next week on the Weekly Edge.
Absolutely. Cheers.
Thanks for tuning in to the Weekly Edge. At Gilt Investments, we're here to help you navigate the fixed income markets with clarity and confidence. As an Australian fixed income brokerage licensed to advise and deal in fixed income securities, our experienced team is ready to help you reach your investment objectives. We hope you enjoyed this week's Edge and that it helped keep you in the loop and ahead of the curve. Until next time, stay sharp, stay focused, and we'll see you on the next episode of the Weekly Edge.